Welcome everyone to our presentation about working capital loans. I'm Jerry Detweiler, Education Director for NAV, and this is an important topic for many small business owners who are just trying to operate their business on a day-to-day basis. So what we want to do here is explain when working capital loans make sense, some of the qualifications involved, where you can find these loans, and how to determine whether this is the right type of lending to maintain or grow your business. So I'm glad you've joined us today. The terminology working capital is sometimes confusing, and if you're not from an accounting background, it's understandable. It's not something that most of us think about on a day-to-day basis. But working capital is simply the money that you need to make your business operate. So when you look at the money that you have coming in and in your business, and you subtract the money that it needs to pay for current liabilities. So we're generally talking about debts that are due within a year. It can include the payments, of course, that you're making on longer term debts, but it's not the entire debt itself. That would give you the working capital that you need. And for so many business owners, this is crucial because cash flow is a big struggle and a challenge for many business owners. And so they run into working capital or cash flow issues that can constrain their ability to operate or to grow their business. So a working capital loan is designed to fill this need, to help businesses operate and to make sure that the bills that need to be paid right now are able to be paid and that the money is flowing in the business without causing severe headaches for the business owner. So a great example of a working capital loan is the Economic Injury Disaster Loan, or EIDL. And some of you may have taken advantage of this. This is a low interest rate loan made by the SBA that was available to businesses impacted by the coronavirus pandemic. We wrote an article on the NAV blog about ways you can and cannot use your EIDL or EIDL loan. And that's generated a lot of questions because business owners really don't understand necessarily what working capital loans involve. So an example in the EIDL program is that they don't want you using it to relocate the business. It's not really designed to expand the business. It's really designed to pay those essential expenses that the business needs to continue operations. Now, could it be inventory? Absolutely. If you need inventory to be able to sell, then that could be a working capital expense. But would it mean relocating to a brand new location because you want to expand? No, that would not be an example of a working capital loan. So really you're looking here at your monthly debt payments, on especially short-term debts, and then you're looking at the money coming into your business. So this is something that you're going to want to look at for a short-term need versus a long-term need. It's not an expansion loan, it's a short-term need. It can cover a lot of different expenses for your business, but it's not typically going to be a long-term loan. It also won't necessarily solve cash flow problems. So we will talk later in this presentation about some alternatives if you're finding that it's hard for you to secure a working capital loan for your business. So when can they help? An example would be you have invoices that need to be paid and you need some money right now. I owned my own business for over a decade. And my experience was that the larger the client, the longer they took to pay. And so sometimes I would have a significantly large outstanding invoice waiting to be paid by a client, but it could take 30, 60, 90, sometimes 120 days or longer for them to pay that invoice. In the meantime, I had to pay the expenses of my business. So that was an example where a working capital loan could be advantageous. Another is seasonal businesses. So if you operate a business that's seasonal because of where you're located, for example, in a tourist area where there may be a season to your business, or if you operate something like a retail business where you have seasons where you need to ramp up for inventory, to buy inventory to sell over the Halloween holidays, for example, the Christmas or end of year holidays. It may depend on your business. If you have a business geared toward outdoor gear, maybe it's the summer season is your big season, then you may need some financial capability to get through to that season so you can make your sales and then stock up as much as you can for the next year. And the others might be you just need time for a business investment to pay off. So maybe you have expanded to a new location and you've got that under control, but you need to ramp up before you'll really be making the kind of money that you expect out of that location. And so a working capital loan can help you pay the payroll or the other expenses that need to be paid in your business while you make that investment pay off. So a working capital loan, you will see this terminology sometimes associated with lending products. So they might say we offer working capital loans, but really the type of loan that it falls under will vary depending on the lender and the product that they're offering. So it could be a short-term term loan. So a term loan is a fixed amount of money paid off back over a fixed period of time. And there are some short-term term loans. So there are loans that are maybe 12 to 18 months. They fully amortize, which means you pay interest and principal, the money you've borrowed, over that time period. So once you reach the end of the time period, it's paid off. You're not just paying interest only with a big chunk to be paid later. So short-term term loans may be an option. Lines of credit can be very appealing when it comes to working capital because they allow you to just borrow what your business needs. So you have this amount of money that's available that you can use when you need it, and you only pay interest on what you borrow. So that's in contrast to a term loan where you borrow a certain amount of money, you're going to pay interest on all of it over the time period that you repay it. With lines of credit, you're going to be paying back you're going to be paying interest only on the amount you borrowed. And then once you pay it back, you can borrow again. As long as the lender continues to keep your line of credit open, it's there for you to borrow against as you need it. A credit card is an example of a line of credit, but also there are many lenders who offer lines of credit to small businesses, and they could be short-term lines of credit or longer-term lines of credit, but it's not usually a very long-term product in general. Merchant cash advances or business cash advances, these are products where there's typically a weekly or daily payment associated with it. And so these products are not usually based so much on credit history as they are on revenues. So they're looking at the revenues coming into your business and advancing you part of those future expected revenues. And then to pay it back, they'll take payments on a weekly or daily basis, either out of your bank account or out of your merchant account that you use to accept credit or debit card payments. There are also some variations, of course, if you use certain payment gateways where they will take it out of that account as you make future sales. This type of financing is typically quite short term. It's typically the more expensive type of financing, but because it's very credit flexible, it's popular with business owners who may not qualify for more traditional lines of credit, or term loans, or SBA loans. Now, in SBA loans, I did mention the economic injury disaster loan, and that loan is still available through the SBA for businesses impacted by COVID-19. That is a 3.75% loan repaid over 30 years, and it has some very attractive features to it. And right now, payments are deferred, so you don't even have to make a payment on your EIDL loan if you qualify and get one. The SBA has recently raised the limit from $150,000 to $500,000 for businesses that qualified. However, there are other SBA loans out there, and the SBA EIDL loan is only available directly through the SBA. But disaster loans, including that loan, are the only ones the SBA makes. Everything else, they outsource it to lenders. They approve lenders to make SBA loans. So there's a variety of programs in this umbrella. The most popular is the 7A program. That's sort of the flagship program. And it's possible to use 7A funds for working capital. There are some variations of the SBA 7A program. There's the small loans, there's the express loans, which are designed to be faster. There are also export loans for businesses that want to or do engage in exporting. So there's a variety of different programs out there. The tip I would say for SBA loans is to remember that the SBA sets the floor in terms of requirements. The lender has to meet the SBA requirements in order to collect on the guarantee from the SBA if the borrower defaults. But beyond that, the lender can make their requirements a little bit more stringent as long as they don't discriminate or violate SBA guidelines. So what this means for you as a business owner is that you may need to shop around for an SBA loan. In other words, just because one lender says we can't make this SBA loan for you doesn't necessarily mean another lender might not be interested. It doesn't mean you're guaranteed, but it's possible you may find another SBA lender. So we do at NAV match borrowers to an SBA partner, and we'll talk about that in just a moment. But do keep in mind, these loans are very attractive. The interest rates are typically low, no real hidden surprises, but they do require good credit. And so you will have to be able to qualify. So they're not the easiest or fastest loans to get, but they're very attractive loans for businesses that do qualify. So just to recap some of the qualifications here, I want to make sure you have an idea in your head of what might be available. On the short-term term loans, typically you're looking at good credit. Doesn't have to be super high, but good credit, revenues, often 1 to 2 years in business minimum. Some lenders are going to be 1 year and some are going to be 2 years. So it does depend on the individual lender. For the lines of credit, you're going to see a similar scenario. And then for merchant cash advances, it's going to be based largely on revenues, the sales that are coming into your business merchant account or your business bank account. That's where they're going to make the heaviest decision is on that. SBA loans are almost always going to require a personal credit check, a personal guarantee, and they want to see good credit. And often, many lenders prefer to work with established businesses, although there are some that will work with startup businesses when it comes to getting an SBA loan. So there is some flexibility there. So is a working capital loan right for your business? Well, there are some questions to ask. So are you likely to qualify? We laid out some of those qualifications just a moment ago. Can you afford the payment? This is really important. And I don't want business owners to be just focused on the payment, but being able to afford the payment from future cash flow is going to be essential, because if you can't, and this does happen especially with some of the higher cost daily and weekly payment products, where the business owner discovers that payment is so affecting their margins that they're actually digging the hole deeper and they're not able to get out from under. So you definitely want to make sure that you understand your business finances enough to know that you can afford that payment out of your future cash flow. You may also want to see whether you have alternatives. For example, if you work with vendors or suppliers to get inventory, supplies for your business, etc., they might be willing to offer you a payment terms. And typically, they don't charge any interest on this. So we did a whole separate talk on vendor trade lines and vendor financing that would be worth it for you to check out on Bright Talk as well. But with vendor terms, they typically don't charge an interest rate, but you might give up a discount. So for example, they might offer you no interest charge on net 30 terms, which means your invoice is due in 30 days. Or they might give you a discount, say a 2% discount if you pay in 10 days. So rather than wait that 30 days, if you pay right away, you get a discount. So that could be a cost of taking advantage of that financing, but it can be very flexible for many businesses. And once you establish a good relationship with your vendors, often you can ask for more extended payment terms because they want to keep you buying from them and not from their competitors. Business credit cards are another alternative for working capital. A lot of business owners think of them as a convenient way to pay or a way to earn rewards, both of which are great, but they also can be a good source of short-term financing at a reasonable interest rate. You're probably going to see an interest rate on business credit cards for purchases somewhere between 16 and 20%. So it's not the lowest cost financing out there, but it is lower than other types of fast financing that might be available. And in that sense, it could be flexible for you to tap a business credit card, at least for short-term needs in terms of your cash flow. And of course, there are some credit cards that offer 0% for a year, 18 months, or 0% for a limited time period on a balance transfer. And that may be attractive as well, as long as you can pay it back before the interest rate goes up and you pay more interest. So a few things to check out when you're considering a working capital loan of whatever type it may be or whatever source it may be. You want to understand the interest rate. You want to know whether that is fixed or variable. Is it going to be the same rate for the life of the financing, or is it going to be variable? Now, this will likely be confusing with certain types of financing, because with small business financing, lenders are not required to disclose an APR, annual percentage rate, which is what we use to shop for car loans and home loans and student loans and other personal loans on the consumer side. On the business side, they typically are not required to disclose an annual percentage rate. So I'll give you a quick tip here. If you go to nav.com/calculator, you will see our free calculators. They don't collect personal information. They'll just allow you to translate the cost of an offer into an APR, so you can see how it stacks up against other types of financing that you may be considering. Hopefully that will be a useful resource for you. There may be fees. In particular, I check to see if there's an origination fee and an annual fee. Some of these types of financing will charge an annual fee, which may be fine if you're taking advantage of it. But let's say you get a line of credit, you're not using it, and you forget about it, that you could get hit with an annual fee. And if you don't pay it, you could end up being delinquent on that account. So you do want to pay attention to that. And then you want to understand your payments. Are the payments themselves going to be fixed, or will they change over time? Is it daily, weekly, monthly, etc.? And as we mentioned earlier, can you afford to pay those payments from cash flow? Those are some important questions you want to ask yourself. And if you're not comfortable answering those questions yourself, you may want to get with your accountant or a business mentor like your Small Business Development Center or SCORE, which offers free help to small business owners. So how do you apply for a working capital loan? Well, certainly you can check with your local bank or credit union and see whether they offer them. I always maintain that if you can get a bank loan, it's probably going to be the best money you can get, because it's going to be probably the lowest interest rate and most familiar terms in terms of how the loan works for your small business. But we know from lots of research that many business owners will not qualify or won't find a fit with their local bank or credit union. There's just fewer that are making smaller small business loans these days, and it can be harder to qualify. Banks often want to see at least 2 years in business tax returns, solid revenues, financials, and lots of paperwork. So the other thing I would recommend you do is check and understand your qualifications with NAV. So at NAV, we are a marketplace. We're not a lender. So we are matching you to financing based on your qualifications. We don't sell your information to these lenders to start calling you because you've signed up for a NAV account. Instead, we show you within your NAV account the matches that may be available. And then we also have a team that you can always reach out to and schedule a time to talk on the phone to go over the options that you're seeing or other options that may be available for your business. So that's a way to search among multiple lenders with an account that is free at the basic level. We have paid accounts as well that offer additional benefits, but the free account is one that is popular with many of our NAV customers, and that's a great way for you to see what may be available. So once you do that, if you sign up, go onto your Marketplace tab and see what options may be available to you. Also, tip, if you're going to go that route, fill out your profile fully, because the more information that we have at NAV, the better the match we can give you. Again, we're not doing that to sell that data to lenders. We're doing that to match you to financing. And the more accurate and up-to-date it is and complete it is, the better the matches that we can show you based among the many lenders that we work with around the country. So once you see matches, you want to evaluate the cost and apply for those that make sense to you. And then, of course, you want to pay on time because that payment history may be reported to your business credit. Occasionally, these loans may show up on your personal credit. For the most part, most of the true business loans will not show up on your personal credit unless perhaps you default. But even SBA loans don't report to personal credit. So oftentimes, as long as you can maintain your payments, your personal credit is not going to be a factor in terms of reporting. Some lenders will require a personal guarantee, others will not. So it depends on the type of financing the lender, and that's something you can find in your loan agreement, or you can ask the lender if you're unsure about that. We know we have a lot of NAV customers who are trying to move away from personal credit into business credit, and sometimes that's an option, but it will depend on the lender's policy as well as your qualifications. So let's talk about a few alternatives. If you discover that, hey, my credit or my revenues, they just aren't strong enough because maybe business has been really impacted by COVID, they've already taken advantage of the EIDL program, still looking for some additional help, but you're not eligible right now for financing. I'll say two things. One is that the good news is we are seeing lenders, starting to lend again at NAV. So keep on top of those matches that you see, because we are seeing more and more lenders coming back into the market and looking for good opportunities to lend to small businesses. That's how they make money. So they ideally want to make loans. And then also look at other ways to improve your business finances and sort of increase working capital from inside. So that could be, maybe it's time to evaluate a price increase. Maybe it's time to look at other streams of revenue that you could add to your existing customer base so that you can bring in more money. I mean, ideally, that's going to make you more appealing to lenders, as well as just make your business more financially healthy if you have strong revenues. Consider implementing late payment penalties. Make sure you check on what's allowed in your state, but either a penalty or an incentive could be helpful to get your invoices paid on time. So let's say, for example, you have a client that consistently pays late. Maybe you want to offer them a late payment penalty if they pay late, or a discount if they pay faster. You can find out what's legal in your state, test the options, and see what works for your business. But this can often improve your cash flow and make your customers either happy or unhappy, depending on whether you have to charge them a penalty or offer them a discount. And then really mercilessly evaluating your expenses so that you're only spending money on what you have to in order to run your business or to make money. There's probably some breakage here, probably some things you're paying for that aren't necessary, that if you eliminate those expenses, it improves your business's financials. And that's a benefit to you, not just in terms of a more healthy business, but again, more attractive to lenders as you improve these ratios and improve your finances for your business. So that's what I wanted to cover today. If you have any questions, we're happy to try to answer those. We do write about working capital loans on the NAV blog. So you can always check out nav.com/blog, and you'll find working capital loan articles there, as well as articles on all types of business financing. And then we have a variety of other presentations within our Bright Talk account that may be useful for you in terms of making your business more attractive to lenders. So make sure you check out the other talks so that you can build a company that lenders, it's a no-brainer for the lender to want to lend money to your business because you are a financially healthy and attractive business. I hope you found this helpful, and we hope you'll come back for more financing education. And most importantly, we hope your business will be successful and get the financing it needs to continue to grow. So thank you so much for joining us today.